Dave, thank you for coming in to share your perspective on a few key topics. I'd like to kick things off with getting your take on long-term interest rates, and in particular, where do you see the 10-year government of Canada in 12 months from now?
Well, I'll tell you this much. Giving point estimates in 12 months is always a mug's game, but I will tell you that I think the overall direction in long-term interest rates is going to be flat to lower. It doesn't mean that we can't back up alongside the U.S. on a near-term basis, but I think that the structural deflationary forces, demographics, the fact that there's just too much debt globally is a big constraint on interest rates. So my sense is that as low as long-term interest rates are, the risk is that over the next, say, 12, 24, 36 months is that they're either where they are today or they're probably marginally lower.
Right, and I think that's very interesting and relevant, certainly for the commercial real estate industry. I've heard you recently talk about these structural forces and how they're actually more relevant than who's in the White House. Can you elaborate a bit on the sources of this demand for long-term government debt?
Well, it's what I call Trumponomics battling 3D, and the D's being demographics, deflation, and debt dynamics. And so really what we have here is a situation where we're still awash in supply across many goods and services around the world, maybe not so much in oil and commodities right now, but when you're taking a look at final goods and services, one of the reasons why you're not seeing much inflation is that there still is too much supply. So that's a constraint on the inflation side of the equation. One of the things that Donald Trump or if Hillary Clinton had won or anybody else, the reality is that there's no leader that can make us younger. I wish that were the case. I'd love to be younger again. But what's really interesting is that we have a situation where in the past year, the first of the baby boomers, this 80 million pig in a python in North America that's driven everything in the past 6 decades from economics to politics to finance. I mean, Donald Trump is a boomer. But the reality is that they turned 70 in the past year for the first time. And so when I say pig in a python, it's because it's such a huge mass of the population, and that's where the wealth and power is really controlled. There's going to be 1.5 million baby boomers in North America turning 70 each of the next year for the next 15 years. Wow. And the reason why that's important is from an asset mix perspective, because when you turn 70, whether you know it or not, you're actually engaging in the most profound asset mix shift in your personal finances since you first got your job and you started loading up on equities. When you turn 70, naturally what you start to do in a very significant way is you start to become more conservative. So you start to shed your equity exposure in favor of fixed income. And so right now, the real challenge for the baby boomers is getting this income in a period where, you've got extra low interest rates. So this is an ongoing challenge, but this demand for income, whether it's out of real estate, as you had mentioned, whether it's out of dividend growth, dividend paying stocks in the equity market, whether it's out of the bond market, corporate bond market, government bond market, this stretch for yield is not going to go away just because we have a new president. And then I talked about the debt side of the equation, and debt is a pervasive constraint. What's very interesting is that when you take a look at the overall debt ratio in the world, at every level of society, government, businesses, and households, the debt to GDP ratio today is 235%. Where was it at 2007, the peak of the last cycle? 235%. There's been no deleveraging. Mm-hmm. So the debt size, and especially in Canada, in Canada that ratio is 290%. We're 10 percentage points above Italy, right, as if that's something to be proud of. But what that means is that interest rates do not have the capacity to rise because of the implications for your debt service costs. So all these things together comes down to our primary conclusion here. No matter who's in the office, interest rates, bond yields are going to be staying low for the foreseeable future.
Okay. Now, you talk about these, astronomical levels of debt. So what's your take then on growth and your, say in particular, your GDP forecast for both the US and Canada over the next few years?
Well, again, not getting into point estimates because having done this for 30 years, the economists always get it wrong.
You said that you make the weatherman look good.
Well, that's right. That's one thing about economists. Well, what's interesting is that with all how the pollsters right now, because of Brexit and because of the U.S. election, the pollsters are under attack. But actually, I like the pollsters because they're making my profession, the economist profession, actually look really good.
It's all relative.
Yeah, it's all relative. So, look, I think that the situation we're in is very complex. The excessive debt situation means that we're going to be stuck in a low growth environment for an extended period of time. So that acts as a fundamental constraint. I think that you can take a look at Japan as a modern day example of what it means to carry this excessive debt, and you can try and fiscally reflate all you want, but when the society, when the people that do the spending in the economy see the level of debt as a future tax liability, then that constrains their economic activity over the near term and intermediate term. So, I think that one of the big fallacies right now is this mantra, Brian, I'm sure that, that you've heard it, about that the baton is going to be passed from monetary policy to fiscal policy. This is one of the supposed great things about the Trump victory is we're going to get fiscal stimulus. There's no doubt that monetary policy is tapped out. And every central banker knows that. I think most high school students know that when you get to 0% interest rates, the efficacy of monetary policy in terms of influencing economic activity diminishes rapidly. So you go to the quantitative easings or negative interest rates, which is a very risky and a big mistake that the Europeans did. When you get to 0% interest rates, the ability to influence growth is not what it was when you can go from 6% interest rates to 5 to 4. Well, the same holds true with fiscal policy. There's no baton to be passed because fiscal policy is as tapped out as monetary policy is. And so you can't, you have to operate an economy with credit, no doubt about it, but it's not a linear relationship. Once you cross, say, 70% federal government debt to GDP, as you have in the United States, U.S. today is 77%. This is not the Ronald Reagan days when the debt ratio was 30%. The fiscal stimulus that you get at ever higher levels of the debt ratio has practically no impact at all on economic activity. So what has to happen ultimately is we have to basically pay the piper. We have to have the tough medicine of deleveraging before we can get to the next sustainable stage, the holy grail of sustainable growth and inflation and ever higher interest rates is going to require that our balance sheets globally, and I say especially in Canada and in the United States, gets in a much better shape. Here we are, 8 years after the epicenter of the crisis, and we still haven't solved the fundamental issue that there's too much debt. The only reason why it appears to be stable is back to what we talked about in the opening moments of this segment, which is that you can't have the higher interest rates on this high level of debt or else it'll throw the economy back into recession. So we're carrying the debt because interest rates are so low. Point number one is how sustainable is that? But until we actually get debt ratios to more manageable levels globally, and that includes China, includes Canada obviously, we have one of the highest debt ratios in the world when you consider the provinces and the consumer, we're going to be stuck in this sort of 1 to 1.5% growth economy for an extended period of time.
Well, and you've been saying, writing a lot recently, Dave, about the equity market and how it has blinders on, and I think you've touched on some of the factors that you would attribute that, but even just in general, your take on the equity market going forward?
Well, I think the equity market itself, I think the sentiment is far too bullish right now. You have about 4 bulls out there for every bear, so my contrarian antenna gets very sensitive to that sort of herd mentality. Second point,
even though you say you're not the perma bear that you've been labeled.
No, not at all.
Yes.
But it's recognition that look, there's different things to look at with the stock market. Again, it's complex. There's technicals, there's sentiment, there's valuations, there's fundamentals. The technicals don't look so bad right now. I would be the first to say the technical picture actually looks pretty good. Sentiment is too bullish for me as a contrarian. The valuations, we've got price earnings multiples, no matter how you look at it, at their highest levels in 15 years. And then you've got the fundamentals. And look, the earnings recession in the United States, thankfully, is over. But when you're taking a look at what a normalized price-earnings ratio would be, a fair value, call it, to justify the valuations in the marketplace today, you've got to have a view that corporate earnings are going to go up 30 to 40%, which is about a 1 in 20 event. Usually the 1 in 20 event is coming out of recession, not the 8th year of a cycle. So there's lots of arithmetic out there about what does Donald Trump with Congress going to accomplish, not accomplish, between capital repatriation, what that means for stock buybacks. That has an influence on earnings per share, and of course how you would justify the multiple at this level. Or say corporate tax rate cuts. How is that going to filter through? Deregulation. How is that going to add to animal spirits? That influences the market multiple, but also tangibly, what's the implication back for earnings in the financial sector, the energy sector, the two areas of the stock market and the economy that'll be mostly affected. There are a lot of bright analysts and strategists out there in the U.S. that have done a bottom up and say, we might be able to get to these levels. I'm a little more skeptical as to what's going to actually come out of Congress in the end. And then, of course, we have the offsets, which are trade protectionism, and the trade barriers and tariffs, which are going to have some sort of an offset.
Well, and on that, David, I'm glad you touched on protectionism and that. So, there's been talk about this border adjusted tax, and if some sort of varying degree, but that was implemented, how would you see that impacting the Canadian economy?
Well, let me say first and foremost that I don't think we're going to see the BAT or the BAT. I don't think that's going to happen. I'm actually, in Canada, of course, we do hope that that's the case, because they slap on those tariffs on Canadian exports into the U.S., and you'll be talking about a recession in Canada. There's no two ways about when you do the arithmetic of what, say, a 10% tariff would mean when you consider that we ship between 20 and 25% of our GDP to the U.S. There's no question it would send us into a recession of, call it a 2 to 3% contraction in GDP, which I got to tell you something would be no picnic. But I have some contacts in the U.S. I was surprised actually that this is the plan that Paul Ryan had been working on, but I think from his perspective, he wants to kill two birds with one stone. Corporate tax reform, great, but really cloaked beneath it is trade protectionism, which feeds right into Donald Trump and his team's very isolationist, very nationalistic stance. I think anybody who's watching you and I right now, I would advise them right away, if you haven't done this already, go read the Inauguration Day speech. Very dark undertones, but very nationalistic, filled with a lot of trade protectionism. My sense is that we're not going to see the BAT. I think that will Donald Trump abrogate the NAFTA? He went on record as saying that he will, and guess what? In the NAFTA itself, it gives all three parties, 6 months leeway to walk away and renegotiate. I expect he's going to do that. How that plays out for Canada remains to be seen, because there's a very good chance that if the U.S. walks away from NAFTA, we revert to the free trade agreement, which Canada always wanted in the 1980s. We were the ones that went to the Americans for the FTA. And actually, when you take a look at how our manufacturing sector was gutted, the hellowing out of manufacturing in Canada was far more acute than it was in the United States. So actually, walking away from NAFTA, doing something different, that part actually, I think, could be very beneficial for us.
Interesting. While we're on the Trump administration, do you see any policies there that could help put Alberta back on track?
Well, I think that the pipeline expansion, approving Keystone, for example, these are things that'll be potentially positive. Of course, it has to be with U.S.-made steel and so on and so forth. So this comes back to made in America. I think it cuts both ways. I think that there will be more pipeline expansion, no doubt about that. The deregulation will certainly help out the flow of oil from Canada, Alberta into the U.S. At the same time, and this has really nothing to do with Trump, except maybe it comes down to the deregulation part of it, is Alberta is not a low-cost producer. So I think that if you're going to be bullish on energy, the focus is really on the energy capital spending budgets in the U.S. I think that shale, especially at these prices, we know that the guys in the States are very, very profitable at oil over $50. So I think that's where you want to be focused. I think that where energy prices where they are, and of course, again, nothing to do with Donald Trump, but that has more to do with the fact that this OPEC deal is sticking. Global demand is not contracting, it's growing moderately. Remember, this time last year, it's interesting, we'd be talking about oil below 30, and everybody's talking about it going to 20, which never happened. But we're in the low to mid 50s. I think that puts a floor under Alberta. And I think Alberta is a long-term restructuring story. But investment is not going to come back into Alberta anytime soon, not at these energy prices. We need them a lot harder than that.
Got it. Canadian dollar. you pull out your crystal ball and where you see the Canadian dollar, the direction there, and call it over the next 12 months.
Again, I'm going to refrain. Well, actually, this time around, this is a high conviction call. I think there's a very good chance we'll see 70 cents again on the Canadian dollar. People say to me, I say 70 and 80 in the next, say, 12, 24 months, but I see 70 cents first. And the reason is it's not about the oil price. It's interesting that based on where oil is today, say $52, $53, the Canadian dollar, in quotes, should be at 80 cents, or call it 125, but it's not. And the reason why it's not 80 cents is the crux of the matter here, which is Bank of Canada policy. So as the Fed raises interest rates, and they'll continue to raise interest rates gingerly, the Bank of Canada is not doing anything for the next couple of years. So what's preventing the Canadian dollar from being at 80 cents where it should be based on oil alone is because our interest rates are so far below the US. Well, that negative interest rate differential is going to be widening over the next 3, 6, 12, 24 months, and that's going to put downward pressure on the Canadian dollar. I mean, the reality is that when you take a look at what housing has done for Canada in the past couple of years, such a principal source of economic growth, and now with these CMHC changes to affordability, you're going to find housing is no longer going to be the contributor. Canadian household finances, the debt is just a huge constraint on consumer spending. So where's the valve going to be? Where for growth here is going to have to be exports. Yeah. And so irrespective of what a border tax could be if that came to fruition, or anything else that the U.S. does, the Canadian dollar is going to go down principally because of this divergence of monetary policy. And the Bank of Canada wants to have a weaker currency to boost exports, to really act as that antidote or that offset to what we're going to be seeing in terms of a flat housing market for the next while.
And where that's interesting, Dave, because where it relates then to commercial real estate is in 2016, our valuation group here at Cushman, and we've worked with foreign investors who've placed over $3 billion into commercial real estate just last year alone. And when you ask them, kind of why Canada, they view our commercial real estate as on sale, partially from a valuation standpoint relative to other markets, but also from a currency standpoint. I want to close on more of on an opportunistic kind of theme of when you are traveling across the U.S. and asking, or you're being asked from investors, where do you see opportunities in Canada? How do you respond?
Well, it's basically the answer is this, and it's not a question posed to me, Brian. It's actually a statement that Canada is being increasingly viewed, especially post-Trump, but also take a look what's happening in Europe in the coming 12 months. Uncertain election, we have, Brexit's going to become a reality, most likely. Then you got the elections in the Netherlands, France, and Germany. So Canada right now is looking as a bastion of political stability in a global sea of instability. So you're 100% right. Foreign investors like the Canadian dollar where it is. So Canadian assets look cheap to Americans in particular based on where the currency is. And we're looked at politically stable place to visit, to actually live, and to invest in. So I think that we have a lot of great things going for us, especially on a relative basis. But the political stability factor, no matter what you think of the Trudeau government, what you see is what you get, for the next several years. And it's not the case actually in most other parts of the world. So we're getting more of a political premium on that. And that's one of the reasons why Toronto real estate in particular, whether it's commercial, residential, industrial, is still going to have a premium attached to it for the next several years, in my opinion.
Fascinating. Dave, thank you.
Thank you.